All right, what's going on, folks? Welcome back to these lectures, these videos, these lessons, these creative assignments, whatever you want to call them. In this video, I would like to break down my wheel method, or how I employ what's called the wheel method, basically where you're writing off puts and writing off calls at the same time on the same security. So I'm going to give an example through this stock called ChargePoint. It was the first stock that I really tried to use the wheel method with. It was kind of funny because one of the teachers I had, he started with ChargePoint, but it was like unrelated. Like we came upon this stock on in different ways, like in a different time period. So, but I like it because it has a lot of advantages, especially when I didn't know if I wanted to put a bunch of money towards this strategy. It's a good stock. Well, at least for me, it was a good stock to start with. And I recommend, if you're starting the wheel method, to start with lower priced stocks that still offer enough, I guess, implied volatility that you can collect a good premium off of writing contracts. So how the wheel method works is basically where you can write a call and a put on the same stock or same asset at the same time. So how does it work? Well, if you purchase a put, you're purchasing the rights to sell a stock at a particular strike price at a particular expiration date or point in time. If you purchase a call option, you are purchasing the rights to buy shares of a stock at a particular strike price at a particular time. So it's really what you're purchasing the right to do. It gets confusing when I say buying a put, where you're buying the rights to sell a stock. And if you buy a call, you're buying the rights to buy a stock. Sometimes that gets confusing. So what you have to know that when you're in possession of a put contract, right, that you've purchased, you own the rights to sell that, asset. When you purchase a call, you're buying the rights or purchasing the rights to buy a particular asset. So on the flip side, when we're talking about selling options and selling puts and selling calls, it's kind of flip-flop. So when you sell a put, you're selling someone else the rights to sell their stock to you, right? And when you sell a call, you're selling someone the rights to buy your shares of a company. So we have to be careful, because when we're selling a put, we're really agreeing to buy something, right? So, and we're selling a call, we're actually selling shares to someone. So what's a good way to get into the wheel method? Well, one way that's commonly used is selling a put. So what I do when I'm starting out the wheel methods, I pick a good stock, I check out its financials and all that stuff that we do already. We check out the company, but then we go into, charting. So that's still part of the normal procedure. So I'm looking on the monthly at big supports and resistances, and I'm just picking a few points that I see. All right, so I've gone ahead and charted up some major support and resistance levels. All of these are pretty well defined. We got some channels here. I've made my support and resistance lines in black. And then, all right, so I've gone ahead and charted up a lot of this stuff. already. We got a couple reliable channels here in recent history. And I started out monthly. I went into weekly, daily time frames, the half day or 4 hour time frame. I really like to use the 3 hour, but the hour. And you can see these are pretty clearly well defined, reaction points, or what I call auction zones. You can see price contained pretty well on the hourly chart within these zones. One thing I want you to see for this low price stock, it has support and resistance, or supply and demand, around where these contracts are going to form. So if you look at contracts on ChargePoint, you'll see that nearer term contracts have about 50-cent increments close to the money. So we're at $9.15, and contracts are going at, strike prices of $7.50, $8, $8.50, $9, $9.50, $10, $10.50, $11, $11.50, $12, etc. So what that's telling me is that those are going to probably be, contention points in the market, or potentially contention points, because if price exceeds those levels in the market on calls, that contract is in the money. If price goes below those levels on puts, it's considered in the money. So buyers and sellers are kind of contending in a way. Which way will it go? And you can see in the chart about every 50 cents. These are not exact, but you can see where support and resistance is. And I use wicks because I want the actual range of where price went. Not just the bodies of the candles. I like using the wicks. You'll see that these support and resistance, or supply and demand zones, auction zones, are happening about every 50 cents. Here's $8.50, $9, $9.50, $10, $10.50, and on. The white grid lines that are running horizontally, those are every 50 cents. And you can see that the support and resistance I've drawn pretty closely matches those, set prices. So, those psychological support and resistance zones, or supply and demand zones. So this is important with the wheel method, because we're going to be selling our contracts. So we want to know where price is likely to go, so we can strategize and set ourselves up well. The other thing I want you to get in your head is that when we're selling these contracts, we want short-term expirations. Why? Because the value of the option is very contingent upon time value, extrinsic value. Like, what is this contract worth over a course of time? Well, if stock price moves against you and you have a lot of time on your hands, the value of the contract's not going to change a lot. But if the stock moves against you and you only have a short amount of time, the value of that contract can change dramatically. And so what we can do is, say we think the stock might turn direction, we can sell a contract. If we think that this stock has bottomed out, we can sell a put thinking that it'll rise. And as the stock price moves away, if we sell a short-term contract, we're going to be in the money on the contract we sold. What does that mean? Basically, if we collect a premium of, let's say, $50, and the stock price moves $1 away on a almost basically a penny stock, that contract might lose 75% of its value. So we might already be collecting, somewhere in the ballpark of $30, $35 on a $50 premium outright. I mean, we collect our premium anyway, but in the event that we want to buy it back, we can do so at a very cheap price, and we can move on. Sometimes it's better to buy back contracts, and I'll explain why later. So keep that in mind. So I bought into ChargePoint most recently around $10.40, I would say. So my cost basis per share was $10.40. You want to keep track of your cost basis. Okay. So I bought 100 shares. That cost me $1,040. Okay. And I'll just write, buy in at 1040 on this. On this line here, and I'll make it in a wild color. So, well, something so you know that that line's different from other lines. Let's do orange. Okay. Ooh. All right, maybe dark green. Orange was a little hard on my eyes, but anyway. So my buy-in is at 1040, and then let's make that line kind of a different color. We can make the line orange. Ooh, man, that orange is rough. All right, so I bought in at 1040, and then I bought in around here in this consolidation. I think it was like maybe the 16th of December. So I bought my share 1040. I want to, if I sell a call option, I want to sell it out of the money so that I can collect a good premium. And most of the good premiums are going to be close to the money because there's a higher likelihood of that contract getting becoming in the money with increased volatility. Stock price moving up and down, chances are I could shoot above, 10 cents above to 1050, and I'll have that contract exercised on me. So those people have to pay who want that contract have to pay a high premium to have it, because I'm offering to sell my shares pretty close to the money. And let's say charge point's on a roll and it goes to $12, $13, $14. Well, if I have to sell it at 1050, that person's getting the benefit of it, of all that price movement. Because when they buy it from me at 1050, they could immediately sell it at those high prices at 14 when they get the shares at expiration. So it makes sense that I'm kind of hoping the price either stays the same or goes down a little bit by expiration so that I can keep the premium and keep my shares. But, sometimes it will exercise, but I also get some capital gain. I get 10 cents per share from 1040 to 1050 in case the contract is exercised. So I will make $10 extra just for if it becomes in the money and I have to get rid of my shares and sell them to someone for at 1050 per share. So what happened, it consolidated a bit and it fell, and it went the next day. I think I got a 1 week expiration. So it expired around December 23rd. So it fell a lot. And I think I've got my candles. All right. So I think I've got my candles opposite colored. I had the green candles going down and the red candles going up. Okay. All right. So, so the stock price immediately fell, and then it went down to $9.77. What you can do, you can pull up an indicator. Let's just use a little help. You can pull up what's called the average true range, and it'll tell you how much this stock moves on average every day. And it'll average out the last 14 days or whatever you set it as. So this stock likes to move recently about 25 cents a day, if that. Somewhere in the ballpark of between 15 and 25 cents, 30 cents, around 20, 25 cents. Okay. So, and we'll get rid of this so I can make the chart bigger. But if the stock price fell within 2 days down to somewhere around 950, that's $1 out of the money. And I've got Monday and Friday's the expiration. I like the hourly chart because these are being held for like a week to a month usually. So I like the hourly because a full enough view of the overall picture while getting detail as well. So if charge point moved $1 out of the money and it moves about 20 cents a day, it has to move up every day by its average true range from Monday to Friday to for that contract to be in the money. So once it fell $1, that contract lost a lot of value, a lot of its extrinsic value, because now time is on my side, and that person has 4 days to hit the strike price, which is, if it fell down here, it's way up here. And look at that big old red candle. So at this point, I probably got 80 to 90% of that trade, that contract is on my side, right? So to speak. I can sell at 80, 90%, or I could just wait till Friday and collect the full 100%. Well, I've already collected the premium, but I could just wait till Friday, and the contract goes to nothing because it's out of the money. It's worth nothing. That strike price wasn't hit. That agreement falls through, whatever. But sometimes I'll sell early so I can start a new contract. Like say the market moved back to 990 the next week, I could do another 1050, collect more premium, but you get the idea. So I can get out of the contracts. I don't like to get out early. I'd rather just know what my premium that I'll receive is and wait a week. The contract either expire useless or get exercised, but hopefully get expired useless more times so that I can, keep collecting premium, and I can keep my stocks and my money, that I put up as collateral. So what I typically do when I'm doing calls or writing off calls, I'll buy sort of close to between like these increments of contracts are 50 cents because it's such a low price stock. Sometimes the increments will be $1 for regular, $50 to $100 stocks. Sometimes they'll be $5 for very expensive. What I like to do is I like to see, like, if I split this in the middle with the crosshairs from 950 to $950 to $10, I like to see like either it's somewhere in the 3/4 space or 1/4 space. So if it's 3/4 of the way to the next strike price, I'll sell a call because it's close enough to the strike price that I'll probably collect a nice premium, but there's still the chance that it might not reach it. In the same light, if it's about 1/4 from the bottom strike price and I bought somewhere in the middle here, I will sell a put so that if I buy, I collect enough premium and I also get a lower strike price. If you sell a call when it's far away from the strike price, you won't get a lot of premium. If you sell a put very far from the strike price, you won't get a lot of premium. So I kind of break this up into quarters, and I can show you if I draw here. So, all right, so I've split this price region here into quarters from $9.50 to $10. And I kind of had to guesstimate. I put like 9.62 and 9.88. But basically I would get a call somewhere in this region up here, or I would sell a call somewhere in this region, and I would sell a put somewhere in this region. But since we're talking about calls, I'll probably wait until price goes around here. You'll get a nice premium. And it's about being patient, because look at the volatility. If this thing's moving 20 cents a day, it's eventually going to touch one of these regions and you'll be able to collect a lot of premium. That's me personally. Some people might like to sell and buy right in the middle. You'll get a slightly less premium because it's kind of, I don't know. There's not a lot of incentive when price is kind of in the middle of two price points, predetermined psychological price points. When price is in the middle of two of a region, right? Because those contracts are in that region. So even the buyers of the contracts are kind of like, maybe I'll wait a little bit. Like if price starts creeping up, maybe I'll buy a call. If price creeps down, maybe I'll buy a put. So you kind of got to think like the buyer to, enter the seller's mind and say, hey, where am I going to get a lot of premium? So now let's say you buy in, and so you buy a call or let's say you enter a covered call and you sell a call option once it gets into this good region here, and the price shoots way up like $2. Well, now you're selling low, and let's say your buy-in point was like $12. You sold a call here and it shot back up to your buy-in point. So your cost basis was $12 and you have to sell at, let's say, $10 or $10.50. So you're really losing money because you bought your stocks at a high price and you sold them at a low price. Even though you collected premium, that premium would have to cover that $150 or $100 you lost, depending on where the stock goes. So the goal is to collect some premiums so that you lower your cost basis, because every $50, $100, $200, $400, whatever you make, that gets deducted from all the money you spent on shares, right? So lowering your cost, you want to keep an eye on your cost basis. So let's say my buy-in was at $10.40. My cost per share is $10.40. But if I buy in again at $10 because I sold a put, my new cost basis between all those 200 shares is $10.20. And so I would lower this red line and relabel it to say $10.20. And eventually, if you keep lowering your cost basis enough with the wheel strategy, you'll basically have free shares because you've gained so much in the market. So another nice thing about covered calls is you can still collect capital gains, because when the stock price goes up, remember, you're holding those shares. So the value of your shares is still going up. Now, let's say you've sold calls at this $9.87 point, and your strike price was $10 right here for your sold calls, and you're going to make $13 per contract that you've sold. So let's say you have 1,000 shares of ChargePoint that you bought for $10,000. You bought them at $10 a share. You sold calls at $9.87, and you sold 10 calls because you can get 10 contracts because you have 100 shares times 10 or 1,000 shares. You're going to get 13 times $10. You're going to get $130 just by holding those shares. And that's just capital gains. You're also going to get the premium from all 10 of those contracts, which might be $50. So you make $500 plus an extra, $130. You make $630 on the whole move. The downside is if all those contracts get exercised, well, you lose your 1,000 shares and you just keep the cash. So using covered calls is also a good way to get out of a stock if you're just tired of, buying and holding, or, you just don't need it in your portfolio anymore for whatever reason. Or you want to get it later at a later date and you just want to get rid of it now. So for scenarios where you're trying to get rid of stock, that's the way to go. You could sell a covered call, right? Until, that you collect premium until it finally hits the strike price, right? So in the realm of cash secured puts, we're playing the market the other way, and we're saying we are going to sell someone the right to sell us shares. So we're selling someone permission to sell us their shares. So maybe they're trying to get rid of a stock, or they're trying to hedge, whatever reason they get a put option, we're selling it to them. We collect our premium, but this time, instead of holding shares as collateral, we've got to hold cash as collateral because we're buying shares. So let's say this, price is around $9.62 and we want to sell a put for $9.50 for $70. So we'll take $70 right off the top for agreeing to the contract. Then let's say it moves down 12 cents. Let's say our buy-in point was $10, but we're agreeing to buy at $9.50. We can lower our cost basis to $9.75. Say we bought 100 shares at $10, and we're going to buy 100 shares if this contract gets exercised at $9.50. So, or $9.50. So our new cost basis will be $9.75. So you can see that selling cash secured puts is a good way to lower your cost basis. So if the stock market's already going to go down, you could just lower your cost basis and collect a premium by selling someone contracts. So you're buying the shares and you're selling the options contract at the same time. So you're collecting a premium to average down. If you don't know that, that's cool, because most people average down by just buying more shares. But if you already have 100 shares and you can buy 100 more, you can collect a premium. And that's why it's useful to have money to play the stock market game. The more money you have, the more cool stuff you could do. So I use the same quarter technique where I break it up into quarters. If it enters this lower quarter, I'm thinking about selling puts, right? Because I'm going to get the most premium here, close to these little incremental strike price is $9.50, $9, $8.50, $8. But I'll split all these price regions up into quarters. Or I'm sorry, these are thirds. Well, you get the idea. I didn't put a middle line here. So all right, so you get the idea. And you won't always get it into that quarter, and you might just need to get rid of a contract, but you'll see price pretty much enters all these zones within any given week. Not always, but see it pass through all the zones here, pass through all the zones here, pass through all the zones here, et cetera, et cetera. So that's useful to know. So you can, so now let's talk about strategies for the wheel method. If I think the stock market is going to continue to go down and I like this stock, I'll keep averaging down with cash secured puts, but I've got to have enough cash to average down. So you've got to think, I average down. You got to think, how many percent points am I going to average down? Right. So I average down about every 10% on these lower price stocks. I'll average down at $10, $9, $8, $7, $6, $5. And then that's about it. I'm not going to really average down when the stock has lost more than 50% of its value. I could just get a cap. I could get a protective put. Maybe I could average down to zero, but it's going to cost me $1,000 plus 900 plus 800 plus 700 plus 600. It's going to cost me about probably $5,000 or $6,000 around that to average down to zero. So I've got to have $6,000 to just play this from $10 to zero if I think the stock's going to go down that much. If you are playing a $100 stock, you should be able to average down at $100, $90, $80, $70, $60, $50. You should be able to handle a 50% pullback in the market if you're really serious about this. And you should have that. You should already have that capital up front. You should also have capital to, roll contracts if you have to. You should have capital to buy more shares if you have to average down. You should have capital for collateral. So you have to have the capital for collateral. And you should also have shares. Like, say the market is very bullish, you should be able to buy at 10% increments of, from, let's say, $5 to $6 to $7 to $8 to $9 to $10. You should be able to buy at those points 100 shares of stock so that you can sell covered calls. So you've got to know what you got to, what money you're playing with. Or maybe you want to average down heavier in deeper positions. Like if it's a $20 or 20% pullback, you might go, average down 25% of your money. If it's a 40% pullback, you might go 75% of your money and then go all in at that point. But you can set where you want to average down. I like to average down heavier when I think the market's at a bottom and just wait, or spend the rest of my money on a protected put. You can get protected puts for a stock that you just have a lot of shares in and it's around your buy-in or your cost basis, right? So that way you can hedge your risk. You can protect yourself from downturns in the market while holding on to the value of those shares, because as the put enters money, you're protected from all the money you lose when the stock goes down. So it's good to know how much money you've got to play, where you're going to average down and how much money that's going to cost. So if I know I have a $20 stock and I'm averaging down every 20%, so from $20, I'm going to average down to $16, then $12, then $8. I should have $2,000 to buy in, $1,600 to buy in a second time, $1,200 to buy in a third time, et cetera, et cetera. And those will be the $20, $16, $12 will be my strike price for cash secured puts. Why not? Right. But I want to wait till it gets close to those points to sell those puts so that I get the high premium. If I go to $16, if I think it's going to go to $16, I want to sell a cash secured put, maybe at 17 or close, so that I collect a high premium. There's a lot of different scenarios when we'll sell calls and sell puts, but I like to sell puts when I think the market may have bottomed out and then ride cash covered calls the way up. And then when I think the market has hit a top or I want to get rid of a stock at a top, I may sell covered calls. Some people might like to sell cash secured puts near the top because they want to average down, or somewhere in the middle if you think it's a strong price point. Some people like to sell cash. Some people like to sell covered calls near the bottom because they're trying to get rid of shares. Some people might sell covered calls near the bottom because they think the price might not move, or they're just trying to get rid of that stock and they've reached a low enough cost basis. So there's a lot of reasons for selling calls and selling puts. The wheel method, we want to keep that stock somewhere in a nice range so that we can just play the market on puts and calls, and rinse and repeat, lowering our cost basis all the while, right? You don't want to raise your cost basis, and you don't want to sell covered calls below your cost basis, because then you're selling your calls cheap. Just like you don't want to buy cash secured puts if the market is super bullish and then you're buying in high and just collecting a little premium and then the market falls later. So there's a lot of strategies. The number of reasons that you could buy a call, sell a call, buy a put, sell a put adds to the health of the market, because people have, there are dozens of different scenarios, probably thousands of different scenarios. And so it keeps the market kind of liquid. So I like to use selling puts and calls against my shares and money because it's a nice form of passive income. It's almost like renting real estate. I buy a bunch of shares of a stock and I can sell covered calls and collect premiums on other people's expectation that my stock will appreciate in value. That's the same as real estate, right? You can have a rent to own thing if you think that your apartment or condo might be worth a lot more money, or house might be a lot more money in the future. You're trying to get rid of it and you're trying to make some extra money. I think they do have options contracts on property. But I like this because it's like I'm holding an asset, or sometimes I call it a machine. And it's like if I had a sewing machine and it could make clothes and I paid $1,000 or something for the sewing machine, but I'm getting $25 for every piece of clothing I make. Well, after I sell 40 pieces of clothing, I've bought my sewing machine, or I've made the money back. And now every piece of clothing I make is profit. It's money in my pocket, after paying for expenses and stuff. But as long as I hold on to my shares, I can keep writing contracts against them. And if the stock moves against me, I can sell cash secured puts and average down and collect more shares so I can sell more calls. So it's a pretty useful strategy. I like to trade the market aggressively too. I like to buy shares. I like to buy options on their own. But this is good for volatile or downtrending markets. If you're unsure which way the market will go, somebody will be willing to buy a call or a put from you, more than likely. So that is selling, also known as writing options. Sometimes they'll say I'm writing options contracts, or interchangeably with I'm selling options contracts. So that's how we write or sell options contracts, calls and puts, and that's how we employ the wheel method. So study this, practice this, try different scenarios in your mind, try different scenarios when you're charting, and find out what works for you with this method. So the last thing I'll talk about is premiums and their volatility influenced by implied volatility of the market. There's implied volatility of an individual asset and there's implied volatility of the overall market. When both are high, you'll get a nice high premium. And there's websites like this called optionvisualizer.com, where you can look at options, screen them for high volatility, and which ones have nice premiums. Sometimes a stock is volatile on its own because it's, having company news. Sometimes the market is very volatile because there's economic news. Those are good times to sell contracts. Why not? Because the premiums are inflated. They're higher. So take that into consideration. I like stocks that you can get a nice 2 to 3% return every 1 to 2 weeks. That averages around to like maybe 7 to 10% a month. A little bit more sometimes. I also like to find little gems that might be volatile for the price you pay. Sometimes you might get a 5% return. More volatile stocks have higher returns if you're selling contracts. Okay, let's talk about rolling contracts before we get out of here. Let's say you've sold a call option and it rallied and that stock went way up. And if you wanted to buy that contract back, you'd lose money because now it's really valuable. To counteract that, if it's a short expiration, maybe it's a week or two out, you could look further out and get a long expiration date or a 2-month long expiration date, either at the same strike price or maybe a higher strike price because the stock has moved. So if the original contract was a week out, we bought in at $10. This stock we sold a call for $10.50. The stock went to $12, so we're way in the money. And we want to, we don't want to wait. We don't want to get rid of those shares. So what can we do? We could say, well, if we sold a contract, with a week left on it, we could buy our contract back at a loss. So say we received $50 for that contract and now it's worth $150. We'd have to pay $150 to buy that contract back. We would lose $100. But let's say we go and sell a contract maybe a month out and its premium is like $175. So we lost $100, but if we sell a new contract further out, we collect a new premium of $175 minus the $100 we lost, or $75. So we can get $75. We just have to wait longer for that contract to exercise, which is okay, but there's a time value to it, right? So we don't like to roll contracts, but sometimes we would in order to not lose our shares, or maybe in the case of where we have a high cost basis, we don't want to sell those stocks at a low price and lose money that way. So rolling has its benefits, but generally, in order to successfully roll a contract and collect premium, you'd have to find something further out or at a farther out of the money strike price to collect that premium, or near to the strike price of the current price, right? So if it was at $12, I would probably get one at $12.50 or something like that, so I could collect a high premium further out. And then there's lots of time value if I get a far expiration date. So you can salvage your sold contracts that way. You can do the same thing with a put. Let's say I bought in at $10. The put was for $9.50, but the price is going down to $7. I can roll a contract. I can buy back that original put at a loss. And then I can sell a put further out at like $6.50. I'd have to go with a farther out expiration date to recoup my losses, because that will have a higher premium than the premium I lost selling a cheap contract, buying a more expensive one. So I'd have to sell a put further out and at a farther out of the money strike price to reclaim the premium that I've lost. All right, folks. So study this stuff, practice this stuff, try different scenarios in your mind, try different scenarios on the charts, and let's get back to it, making this money. I will see you all in the lessons to follow.